It's Wednesday, February 4th, 2026. What you're seeing in precious metals right now is nothing short of historic. In just 48 hours, gold has surged more than 15% from Monday's lows, adding over $4.7 trillion back into its market cap. Silver has exploded higher by 26%, adding another $1 trillion. Nearly $6 trillion has rushed back into precious metals in only 2 days. Gold alone has jumped almost $700 an ounce and has now reclaimed the $5,000 level with another 3% move today. But the real story isn't the price on a screen. The real story is what's disappearing behind the scenes. Silver is leaving the system at a pace we almost never see. In a single day, nearly 6% of vault silver was pulled out. At the same time in China, massive waves of retail money flooded banks to buy physical gold so fast that bank apps crashed and people couldn't even log in. Prices dipped, the public rushed in, systems failed, and buyers were locked out when demand spiked the hardest. This isn't random, it's the same pattern every time. Paper markets say there's plenty of supply, reality says otherwise. System overloads, delayed settlements, access restrictions, technical issues, and then physical metal disappears first and prices adjust later. Young buyers in China aren't speculating, they're responding to uncertainty by choosing tangible assets over promises. When even bank-distributed gold becomes hard to access, that's not a glitch, that's a warning sign. Now connect that with what's happening in the vaults. Over 2 million ounces of silver were removed from COMEX in a single day. Major withdrawals hit Brink's, HSBC, JP Morgan, and Asahi. Registered silver fell to roughly 103 million ounces. Total inventories dropped sharply. This isn't hype, this is documented physical drainage happening while trillions flood back into paper valuations. Paper prices are rising while real metal is leaving the system. They are moving in opposite directions, and that divergence never lasts quietly. China tells the same story. Silver prices surged while vault inventories plunged. Tens of thousands of kilograms vanished from Shanghai exchanges in days. That is physical demand, not trading noise. When prices rise and inventories fall together, the message is clear. Supply is tight, delivery matters, and stress is building beneath the surface. And now layer in the geopolitical shift accelerating everything. In Washington today, the U.S. launched a massive critical minerals summit with over 50 nations, aimed directly at breaking China's control over essential resources. Silver is now officially classified as a critical mineral. The government just unveiled Project Vault, a $12 billion strategic stockpile for metals vital to defense, technology, energy, and manufacturing. Essentially, a metal reserve like the oil reserve. This turns silver from a precious metal into a strategic national asset. With new federal incentives, faster permitting, and emergency supply chain funding, governments are preparing for shortages before the public fully understands what's coming. China's export controls already triggered global scrambling. Now nations are racing to lock in resources, sign sourcing deals, and secure physical supply at scale. While all of this unfolds, open interest in Shanghai silver has collapsed, a classic signal that physical delivery pressure is replacing paper speculation. The takeaway is simple. Prices are recovering fast, but the real metal is vanishing even faster. Paper markets can talk. Vaults don't lie. And when access starts breaking before price fully adjusts, that's how commodity systems reset. Quietly at first, then all at once. If you'd like, I can. All the hot money has now been flushed out of the market. Gold open interest has collapsed to extremely low levels, yet prices have held remarkably well. What you're watching is a full washout happening in real time. The speculators are gone. The only players left are the banks scrambling to cover short positions. The COMEX itself is being abandoned, at least on the short side, because there are no longs left to sell to. Shorts are being passed around like hot potatoes, and that only happens when something very big is developing beneath the surface. The silver physical market is now extremely tight. During the massive silver sell-off, paper shorts didn't find panic sellers. They found buyers who demanded physical delivery. That is extraordinary. Normally, only 1 to 3% of contracts ever result in delivery. This time, far more did. The crash wasn't retail capitulation. It was large players using falling paper prices to accumulate real metal. Let that sink in. While charts were collapsing, physical silver was being quietly removed from the system. That's the proof the squeeze is real. Look at the signals stacking up everywhere. Dubai is already reporting silver shortages with buyers paying 15% premiums. In China, demand for gold became so intense that bank apps crashed and locked people out. Vault inventories drained nearly 6% in a single day. COMEX alone lost 2 million ounces on Monday. Shanghai open interest has collapsed. There are no speculators left, it's only banks covering shorts, while nearly $6 trillion rushed back into precious metals in just 48 hours. The paper flush created the greatest physical accumulation window in years. Now the recovery is underway with dramatically lower open interest and much tighter real supply. At the same time, Ray Dalio is warning the world is entering a capital war. The U.S. just hosted over 50 nations to coordinate critical minerals strategy. Silver has officially been classified as essential for national security. Project Vault, a $12 billion strategic metals stockpile, has been launched. Governments don't create emergency reserves when supply is plentiful. They do it when shortages are coming and access becomes strategic. Now add the growing financial stress. Japan's bond market is under serious pressure. Demand for government debt is weakening, yields are surging to levels not seen in decades, and upcoming auctions are being watched closely. This is the carry trade unwind continuing. When Japanese bonds crack, global markets feel it. The first move is risk-off selling, including metals, but it never ends there. The safe haven demand always returns stronger, and we're already seeing that recovery play out with trillions rushing back into gold and silver. Geopolitical tension remains elevated as well, with ongoing negotiations involving Iran and constant risk of escalation. Any military shock creates immediate volatility, followed by aggressive safe haven flows. The swings may not be over, but the physical tightening is happening regardless of paper price noise. Silver ETF demand is recovering. Open interest is sitting at multi-month lows, historically the signal that forced liquidation is complete and a new trend is beginning. Gold has reclaimed the $5,000 level. Those who shorted into last week's crash are already underwater. Meanwhile, when measured in gold rather than dollars, Bitcoin has lost significant ground, showing that real hard assets are quietly outperforming in this reset phase. So, where does this leave us? First, nearly $6 trillion has flowed back into precious metals in 48 hours. Gold is up over 15% from the lows. Silver is up 26%. This is one of the fastest post-liquidation recoveries on record, while physical supply tightens even further. Vaults are draining, COMEX inventories are shrinking, China can't even process gold demand fast enough, and global premiums are rising. Physical disappears first. Price adjusts later. Second, governments are openly positioning for resource scarcity. Critical mineral summits, strategic stockpiles, national security classifications, accelerated mining approvals. These are crisis preparations, not abundance signals. Third, the speculative froth is gone. Open interest has collapsed. The weak hands are flushed. During the crash, physical buyers stepped in aggressively and demanded delivery, something almost never seen at this scale. Yes, risks remain. Japan's bond market is fragile. Geopolitical tensions persist. Volatility is likely. But these are not normal market conditions. When vaults drain, premiums rise, access breaks, and governments rush to secure supply, it signals a structural shift, not a temporary bounce. The paper market is showing recovery. The physical market is showing accelerating shortage. Both cannot be right for long. Watch access, not headlines. Watch inventories, not noise. Because every major commodity reset in history followed this exact pattern. Quiet physical accumulation first, explosive repricing later.